Good evening everyone and welcome to another live stream. I'm Scott from Property Investment Advisory and I'd like to thank everyone who tuned in last time to our live stream and again welcome everyone who's new. For those of you that haven't tuned in yet, we do regular live streams every 3 weeks where it's all things property related. So we talk about strategy, property, finance, contracts, anything to do with property, you name it, and we cover it. So today's going to be an interesting one because we've got a special guest here today to talk about the accounting side and I guess the do's and don'ts when it comes to property investing. So what I'd like to do is I'd like to hand over to Tony Vidray from AV Chartered Accountants to get his thoughts, I guess, on some common things that we often come across with most people. So thanks, Tony, for being here.
Yeah, lovely to be here. So, yeah, I spent many years answering questions around property and what to do, what not to do. And so, yeah, hopefully we'll have an interesting live stream. And, yeah, please ask your questions because I don't mind questions without notice. So hopefully we'll get to them and we'll have enough time for them. So.
Yeah, and we'll definitely have a lot of time at the end for questions. So if you do have any now or throughout the live stream, please send them in via the link on our website, piaproperty.com.au, or the Facebook page right now. So please send them in. The only silly question, I guess, is the one you don't ask. So I guess, Tony, let's just get into it. The first thing I guess I want to pick your brain on, and a common thing we come across with most people is how to buy an investment property. Yep. Because most people own a home and they think buying an investment property is a similar thing.
Yeah. A lot of people think it's an extension of the family home, and to me, it's two totally different investments. The family home, I've always seen the family home as probably the best investment you'll ever make. It's tax free. Most of this, whenever you sell, if you've lived in that property the whole time, it's tax free. So, to a large degree, it doesn't really matter whose name that's in. The only area that I get involved in trying to advise people is around asset protection. So, we use the stereotypical case. Say you've got a husband who's a high-earning executive. He's in an at-risk position. He might work for a mining company or have his own business where he's the at-risk director, where he can be sued for all sorts of different things. You for an asset protection point of view, you don't want the family home in that person's name. So we try and skew it more towards the non-at-risk person. Makes it very interesting. I've got a couple who she's a doctor and he's a pharmacist. They're both at-risk people, so there's a lot of headaches around all that sort of stuff. So when they come and they say, all right, do we buy an investment property in those same ratios? Well, it completely changes things because all of a sudden the investment will start to earn income. Eventually, when you sell it, there'll be a capital gain. So there's a great line in business start with the outcome in mind. What is it that you want to achieve with this sort of thing? Is it long-term rental? Do you want to hang on to it for 10 years and have that rental growth and also have that capital gain in that area, or do you just want to buy it, fix it up, flip it after 2 years? Because depending on what that intention is from the start will dictate how in whose name it's in. Now that's incredibly important to get the name right on the contract because, as everyone should know by now, you've got this wonderful cost called stamp duty, and if you get it wrong, you'll have to pay the stamp duty again to fix it. Now, I had a case recently where I saw the emails from my client to the solicitor where they outlined the ratios, mum, dad, and the son. I think it was 40-40-20. The solicitor missed that, and when the property was purchased, it was bought a third, and there were some very embarrassing conversations around trying to get that fixed. And there's no quick fix with it because there's just stamp duty all over again. So you want to get that part of it right, and you can only get it right based on the circumstances that you're in. So a couple of years later when things change, then it becomes expensive, all those transactional costs around stamp duty and legal fees. So try and start with the end in mind. What is it you're trying to do? Do you want negative gearing? Do you want positive gearing, which we're going to talk about a little bit? Do you want a capital gain at the end of it? Because that will dictate, do you put it in the person who's got high income? Do we put it in the name of the person who's got low income? Then we'll talk about trusts later on too. That'll start to get things a little bit more complicated and a bit juicier.
A bit interesting.
So there's a lot around, and it pays people to take a breath and ask that question. Get the professionals who know your entire circumstance and say, right, we want to buy this. And if you've got 7 rental properties and you want to go and buy the 8th, ask the question, because it could be something different with that eighth one that they go, right, instead of doing it this way, we're going to do it that way. So get the advice right from the get-go on that.
Yeah, sure. So I guess for our viewers out there, what you're saying is that most people buy a home 50-50.
Yep.
When it comes to investing, there's different structures and you need to really think about that a little bit more depending on your circumstances.
Yeah, that's right. So back in the old days, you were able to purchase it in one person's name, and then the other person would go guarantor. Then the banks got very nervous around guarantor because they had to actually do a lot more work around it. And one of the ways I used to get around it was 99% in one name and 1% in another person's name, because the advantage of doing that was the banks or the finance companies would put a ring around both people and take both of their incomes into account. The problem is they kind of cottoned on from the point of the view of the person who only had a 1% interest in the property. They say, well, hang on, what's in it for you? You're only buying 1%, but you're joint and severally liable for the whole loan. So why are you doing this? So there are some financiers now that I've heard on the grapevine won't allow that. So they're now sort of scaling, you probably said more than me, they're scaling that back to 80-20, and the Banking Royal Commission's had a lot to do with that. So getting that right from the start is, it's paramount.
Yep, great. And so I guess there's lots of different advantages to buying property, but I guess there's different advantages to which way you buy it. So, you can buy a property personally in your own name.
Yep.
You could buy one through a company. You could buy one through a trust or a self-managed super fund. What are the different advantages, just to give the viewers out there, I guess, something to think about that you see?
Overcomplication is the simplification of what I can say to you there. The problem with this tax system in Australia is the receipt of that $1 gets taxed in about 17 different ways. It is incredibly complicated. So if you've got $1 of rental income or capital gain coming in an individual, that's taxed differently if it's in joint names. It's taxed differently once again if it's in a company name. The companies get taxed at a flat 26%, but they don't get the capital gain exemption. You move on to trusts. Trusts don't pay the tax on it. It's whoever they appoint the income to. You've got a problem with trusts with land tax. And then the super fund is 15% or zero. It is just a real challenge for non-accountants to get their head around every single structure. What I say to everyone, if you're not sophisticated investor and you're starting it out, keep it simple. Don't try. I've seen some interesting people try and start out with complicated structures where I just come along at the end. I just save them before they go and spend an enormous amount of money and just say, look, just seriously, just keep it simple. Because if you can't understand, and I often say to people, you may not understand, the whole tax structure, and I don't expect you to go and stand up and lecture in front of people for 2 hours on what the tax structure is, but you need to have a basic understanding of what it is that you're signing up and you're operating under. So for starting out, keep it simple, keep it in individual names, and then as you start to get a bit more sophisticated, you get a bit of momentum, then I would then look at other structures.
And look, I'd have to agree with that, I guess, because we hear a lot out there in the public and come across a lot of different people, and for some reason they've got this fantastic U-Butte idea, and it does sound really, really hard. And we do talk about get the foundation right, the fundamentals right, and just bring it back a little bit. Sounds great in theory, but in reality, you don't need to make it hard.
I was talking to a lovely couple today. They'd come in, and this is the classic case of where things change. So their intention was to buy this particular property and then flip it after a couple of years, and they were taken down a wrong path, which I won't go into. But at the end of the day, what's happened now is that it's in the name of a company. It's now there for long-term rental income, and it's negatively geared. So all that's happening is that the loss is just accumulating in the company because we can't get it out. Had they bought it in their own names personally, they would have got a little bit of negative gearing benefit. So there's some headaches around when circumstances change, and that's a bit of a sad one.
Yeah, it is. So the $1 million question, we hear this a lot and we come across this all the time. From an accounting point of view, should I have a positively geared investment strategy or negative? You probably get asked that a lot.
Yeah, look, we do, and I guess, and I'll say from the outset, I'm a little bit strange as an accountant and a tax person, because I've never really fully got my head around negative gearing. I've never understood why someone would enter into a contract to lose money. If you say that to someone, it sounds ridiculous. And the only reason you do that is to get a tax benefit, right? So back in the days where interest rates were 13, 14, percent, people bought properties and they were negatively geared for a long time, and that's terrific for the person who is on 250,000, the executive. But one day down the track, that property is going to flip into being positively geared. Over a period of time, rents increase with inflation, interest comes down as you pay down the loan. Somewhere along the line, that negative gearing, that honeymoon's going to run out. Now, we spoke off air, and I agree with you that in my experience, or in our experience, we've seen that negative gearing period run for about 5 to 7 years. So what happens after 5 to 7 years, and all of a sudden, instead of getting a nice fat refund, all of a sudden that person is having to pay tax at 47%. Not only that, when they sell the property and make a capital gain, that gain's going to get taxed, at the highest rate. So this is why I say start with the end in mind, because if you're going to hang on to something for a long period of time, interest rates are low now. We're seeing properties negatively geared for 2, maybe 3 years. So maybe for the loss of that sort of tax benefit, you might want to put it in the name of the low-income person, because if you're going to hang on to it, you might have negative gearing for 2 years, but positively geared for 7 years. Well, if you've got the spouse who may work part-time with kids, that's perfect, because that income gets added on top of other income. So I'm not a huge fan of negatively geared, but I respect people who are. And one of the techniques that the person, and this is where you come in, obviously, if that property is negatively geared and all of a sudden it starts to become positively geared, great strategy, buy another one.
Yes.
Buy another one and
Yes.
just
Leverage
continue to stay negatively geared. But somewhere along the line, fast forward with 8 properties, all of a sudden, and again in my experience, all of a sudden one of them will end up being sold for a capital gain. And
and look, I think certainly, from our point of view, and we've spoken a little bit off air about this as well, with everything that Tony and I are talking about tonight, it really does come back to you and your goals and your needs. It really is circumstantial.
Yeah.
A lot of people tend to put the property first. No, you need to put yourself first. What are your goals? What are your needs? What are you trying to do? Have you got the right advice and the right help supporting you? And there's certainly lots to consider and think about around all of this when you're looking to invest. So,
I never cease to be amazed by people who are obsessed with not paying tax, right? And I want to cover that quickly, because what I've said to a lot of people over the years is, look, with the tax system that we have, if you earn $1 and you happen to be in the 39-cent tax bracket, you'll lose 39 cents. But the 61 cents left over is yours. You get to sleep at night. You don't have to do anything with it. The worst scenario is you lose 47 cents. So the 53 cents left over, that's yours. People go to the ends of the earth, I don't want to pay tax. So the dollar that you've received, you have to give it away to someone else. And if you do that, how much have you got? You got zero. So again, I've never understood that. To me, it's all about minimising the tax and maximising the after-tax cash flow.
There's some great points there. So I guess the next question we have for you, and again we hear this a lot, and it's quite a popular strategy the past few years, especially with I guess people with maybe 10 years to retire or getting close to it. It's sort of the last few years of their working life. Should people buy or use a self-managed super fund as a strategy to try and get ahead? Okay,
so that is a very, very specialised area. I haven't got a ticket to advise people on this. This is an area where you get into financial planning. ASIC are really, really coming down heavily on accountants who have not got a licence. Even if someone comes to me right now and says, right, I want you to set up a super fund because I've read everything and I want to go and buy a property, you still have to get a proper statement of advice. The ones that I've seen, we do a lot of super funds, and I walk the talk. So I have a property that I bought in my super fund with borrowings. It's getting a lot harder to get those done now because there's fewer and fewer financiers in the market. The big advantage with doing it in the name of a super fund is that super funds have a bucket of money sitting there, and that's your deposit. All right. So people who've accumulated money over a long period of time, pick a figure, $300,000. If you're not doing it in super and you're looking at a property that's say $600,000, you got to borrow the whole $600,000 or come up with cash. If you've got a super fund, it's a very tempting way to say, well, how about we use that money as a deposit and we only have to borrow $300,000?
Because they don't actually have to save it.
It's already saved.
Yeah,
it's already saved. There's a lot around that. So there's investment strategies, what's your long-term gain, or what's your long-term goal with it all. So it is an incredibly specialised area. In my experience, I've seen a lot of people do very, very well out of those super fund investments, especially when property prices are increasing. And I've also seen people who've bought in the wrong areas and it's been a dud investment. So if you're thinking about doing it, that is and be prepared to spend a bit of money, not with us, with the planners, to get the statement of. There's a lot of transaction costs with that sort of thing. So, but again, for those who don't have a deposit, it's a very, very tempting, a very attractive way of doing it.
Yeah. And I'd just like to add to that, and second Tony, that whatever you do, if you are thinking about super and property in super, it's critical that you don't just run out and do it. You need to talk to a financial planner, get the right advice, talk to your accountant, know exactly the ins and outs of the type of property you're going to buy. You don't want to get this wrong, especially, I guess, in the last sort of few years of your working life. You need to make sure that you get all the parts right and do it properly.
Correct.
So
Not only that, but super funds are a very complex animal, because doing a tax return for an individual, it might cost $300 to $600 depending on how many properties they've got. Super funds are a lot bigger. You're talking a couple of grand every year, because they have to be audited, and they now have to be audited by an independent person, so an independent auditor. So the transactional costs every year are quite high in a super fund.
Yep.
So yeah, if you're gonna go down that path, get the right advice and make sure you know what you're doing.
Yeah, definitely. I guess just for our viewers out there, and some are experienced and some are starting out and some are just trying to get some information, I guess, for when the time is right for them. I guess, what are some of the most common mistakes you find people make? Can you give us a couple of examples?
Well, the one that I gave earlier,
avoid them?
Yeah, look, the one I gave earlier is the one where mum, dad and the son, they bought it in the wrong name. Buying it in the wrong name is pretty crucial. Getting it right from the start, and I've seen a lot of people getting it wrong. They didn't get advice, and all of a sudden the property's not in the optimum name. And so, and the ones that I've seen go wrong are the ones where I get the phone call on the Monday. We just went to an auction on Saturday and just put a deposit down on a property. I need my tax returns done. Super urgent.
Yep.
Tax returns done yesterday for the bank. And you think, hang on a minute, just let's take a breath. Let's go back. What is it all for? If you're going to do it right, from our industry's point of view, because there's a lot of very stressed accountants out there trying to catch up after JobKeeper, you really need to get your financials and tax returns up to date first, then go to a broker, find out what's your borrowing capacity, then you go onto the market and find the property. People tend to do the horse before the cart type scenario, and then it's a massive, rushed, and everyone's heard some bad experiences about, getting closer and closer to settlement, and banks and financiers not being ready. So that's the right way of doing it. The other things that I've seen go wrong are just around land tax. So I want to talk a little bit about land tax. So land tax is this wonderful tax the state governments levy once you get a certain number of properties, and it's all based on land value, and I won't get complicated around that, but you can probably, in this area around Newcastle and the Hunter, Maitland, you could probably own 2, maybe 3 properties before you have a land tax problem. You talked about trusts earlier. Trusts are terrific, except that a trust does not get the land tax threshold. So the land tax threshold at the moment is about $700,000. So that's why I'm saying about 2-3 properties before you pay land tax. Start simple, start in your own name. If you're going to go and put it straight in the name of a trust, it's a very expensive cost every year, which is roughly about 1.7% of the value of the land, not what the sale value is, what the value of general tells you the value of the land is. And that's a transactional cost every single year. So that really mucks up your whole positive and negatively
strategy.
And once again, if you've got a trust and it's got a loss, you can't get it out of the trust. It's trapped in there until such time as it makes a profit. So where I've seen people who've gone and bought properties in trusts and they don't own any other property outside the trust in their own name, and I'm thinking, why would you do that right from the very first one? So that's a pretty. I actually had one the other day where they received an unexpected land tax bill because they how can I say this diplomatically? They kind of knew that there was a land tax bill, but they kind of didn't. But when they went to sell it, the solicitor came along and said, "You've got to tick a box down to say is it subject to land tax," and because it was a trust. So, long story short, they were hit with $37,000 in back land tax, which
got to hurt.
Which is incredible, and I didn't understand this at all because they didn't own any property. Now, had that property been in their own name, that would have been avoided. So the power of getting advice from the start, that's a really expensive.
Way to learn.
Yeah, really expensive lesson to learn. Yeah.
And I guess that was what I was trying to say earlier, that it's very, very important not to just, go and talk to the bank and yes, you can get a loan and go and, go out and buy a property from your local real estate agent. There's a lot to consider. And again, as Tony just said, a 37 grand land tax bill, I'm sure that person will learn now to just maybe take a step back and work through it a little bit slower.
Yeah, that's it.
In regards to that.
And that's what I was saying before, that sometimes you can get swept away by the whole sort of, romance of buying a property, and some people out there that are more interested in setting up structures rather than what's in the best interest for the client. So
okay. And so I guess we might just sort of wrap that up for now, and might see if we've got any questions. I think there's a few that are floating in now. So thank you for everyone that have sent in some questions, and we'll try and tackle some of them. So the first question is from Simon, and his question is, if I subdivide a large block and build on the second part of it, are they both counted as my place of residence?
The short answer is no. The long answer is definitely no. So this is around claiming the capital gains tax exemption when you sell the family home. So here we go, Simon, visually, can you see that? If you have a block of land, firstly there needs to be a residence on that land, okay? And if it's less than 2 hectares and you live in the property, you buy it, you live in it the whole time, you don't rent it out and don't run a business from it, let's keep it simple, you sell it, then all of the proceeds are tax-free. The moment you subdivide that land, and let's just do it without a dwelling on it first. The moment you sell that land, even though the whole land was your principal place of residence, that exemption does not apply because there's no dwelling on it. Okay, so Simon's getting a bit clever now, so he wants to put 2 dwellings on it. Okay, terrific idea. It's now subdivided. The problem is you can only have one property as your principal place of residence at any one point in time. So you can't have. There are some exemptions, and it all hinges around having to live away from your partner and living away from work. But in the absence of some of those really edge cases, if all you're doing is subdividing your land, putting another house on it, renting it out, then that second one you're not going to get the exemption from it. So there's all sorts of headaches, challenges around valuations, because you've got to get a valuation. We've had a few clients who've done this, so I've said to them, okay, you've got to go back and get a valuer to go back and value when you bought that house and land back in 2003 for $250,000. We need a value on what the land was worth and how much the house was. That adds up to $250,000. Then we have the cost of the new house that's on there, and essentially you draw a line down the middle, and it's all percentages and ratios to work out. So one part of it will be tax-free if that's the house, the other part will not be. And that's become a very popular strategy, especially with your larger blocks, your 2,000 square metre blocks, corner blocks, where there was a lot of misunderstanding in the early days, thinking, oh, that's my house, I can just carve off a little bit of land and sell it, and then you got some headaches around GST as well, and developers. So
it's not as easy as it sounds. There's a lot of sort of tricks and little things that you need to be aware of.
Correct.
And okay.
Yeah. So get the proper advice, and again, what's the long term gain? Is it just a long term rental income? You just want to flip it, those sort of things.
Yep. Okay. Next question is from Megan. Does all property investments have to be residential or commercial? I guess that's a tricky one without knowing what do you mean by that. But there are different investments you can get into, I guess, in terms of there's normal residential investments that you can get into, so like buying a house. There are strata, which is apartments or units. There are commercial properties as well. So there's a different mix of investments, aren't there?
Look, no, to answer your question, no. They don't all have to be residential. At the end of the day, it's 100% your choice as to what you invest in. And it all hinges around return and what you want out of it. Residential's a lot simpler because you're dealing with, the cost is a little bit cheaper. You're dealing with people that come and go. Finding a tenant is a lot easier. Commercial starts to get a little bit more expensive, and especially in the good times, you're able to find a tenant quite easily. What I found over the couple of GFCs and recession were there are a lot of sheds that were empty. Now, what I'm noticing now, in my experience, is a lot of office space that's available for rent because people have realised that they can work from home. So there's an enormous amount of general office space that's available. However, in this area in Newcastle, it is incredibly difficult to try and find commercial land, warehouses, all that sort of stuff. They are just rare as hen's teeth. And I've got clients who are trying to find somewhere where they can move to and build, and are having absolutely no luck whatsoever. So it's a lot more. You start to enter, put a few more zeros onto the onto the tail end of the numbers, and so you need to be prepared. And what also happens too, from a security point of view, when you're buying residential property, I'm sure most of you are aware that banks are very comfortable lending up to 80% of the value of the property. Some of them will go to 90, some of them will go to 95, some of them will charge mortgage insurance. When you're looking at commercial property, it's around the 65%, 70% mark. So you've got to fund 30% of that $1.5 million property and the stamp duty and the legals. So you start to enter
bit of a long reach.
You start to enter into
sometimes.
some big dollars. So.
Yeah. Okay.
But commercial properties, look, it's terrific, and again, big costs, but there's also big gains that are involved. There's some interesting capital gains tax rules around if you're selling something that's associated with a business. So there's a lot of tax-free money that's involved there. So it's cool.
But again, coming back to what's your initial strategy? What are your goals? What are you trying to do? Will then determine what direction you go and where you head
what can
from
you
there.
afford?
What can you afford? Yep, great. This is probably a Tony question. So we've got Wendy, and Wendy's question is, what are the advantages, I guess, in new properties versus older properties?
And Wendy's from Byron Bay, so I'm sure there's a lot of old properties up around Byron Bay. I've got a few clients who actually invest up in Byron Bay. It's a wonderful spot. A terrific question, especially in the last couple of years of some tax changes that were made. So. And they all hinge around depreciation on buildings. So, again, one of the things, and I think you're going to get someone on who's a quantity surveyor to talk about this, but one of the things that was introduced in 1982 was that if you purchased a property that was built after 1982 and you get a quantity surveyor's report, the report then becomes a receipt for how much you can claim for capital allowance. And it's all the hard stuff. It's what I call all the concrete and the walls and whatever. So a quantity surveyor will do a report and say, all right, well, that particular property was built in 2004. Based on our numbers, we think it cost the builder $100,000 to build that property. What that means is that you can then write off 2.5% every single year, right? And it's what I call an invisible tax deduction. You haven't spent the money except for the purchase price. But you get to claim $2,500 every single year in your return. In addition to that, what the quantity surveyors would do is walk around with a clipboard and do a lovely report around every little light switch and door and handle and all that sort of stuff. And then that stuff might come to, say, $40,000. And then that was written off over 5 years. So there's $8,000 as a tax deduction every single year. So there were a few changes a couple of years ago where what happens today, if you buy a property, if the property is new, you get to claim both of those that I've mentioned. So the capital allowance on all the hard stuff, the concrete, and then all the depreciation on all your light switches. If you buy a second-hand property, you only get to claim the capital allowance on all the hard stuff. Right? So they've gotten rid of the better tax deduction of the two. So newer property is definitely more attractive to buy because of the tax benefits. However, market forces kick in, and guess what? Your properties are more expensive because they've built that into the price of they've taken that into account in the sale price. So from a tax perspective, the newer ones are a lot better. Now, having said that, what people love to do, because there's a lot of shows on television that show them how to do this and make it look easy. And I've pushed a pen on my whole life, so I've never been able to figure out how to put a door jamb in or change a light or wire up a house. And that is you're buying an old house and then doing it up. So you buy an old house and you think, you know what, I'm going to do this up. So let's say you go and spend $50,000 improving that house, then that $50,000 gets written off at 2.5%. So you get that capital allowance, that
of the renovation internally. Correct. So they still miss out on the building side of
it.
Yep.
So they still get to claim that over a period of time. So again, if you're a smart investor and you can pick a property that might be a little bit run down, and you're able to negotiate a lower price because of how run down it is, keeping in mind that you think, okay, I'm going to spend a certain amount of money renovating it. And let's talk about that very briefly as well. It's not a repair, it's a renovation. I've got a lot of clients who've come and said, oh, I've repaired the place. How much did you spend? $50,000. That's not a repair. And I'll quickly touch on that as well. I'll come back to that. So with those renovations, so it's similar, because you've got, what you have is you've got an old house, but you've got a new little portion that's cost you $50,000, and you get to write that off. Just a very quick technique for distinguishing between a repair and an improvement that I explain to people. A repair is when you spend money to bring something back to its original condition. Okay? Kitchens, classic example. Kitchen cupboard falls off, you replace the kitchen cupboard. That's a repair. But if you go beyond that, it's an improvement. So you take the whole kitchen out and you replace it with a whole brand new benchtop. You've gone more than just repairing the bits that were broken. That's an improvement. And there's some headaches around that. And the classic is the roof. I've had people who've replaced parts of a roof. That's a repair. So a couple of years later, they replaced a little bit more of the roof. So fast forward about 3 or 4 years, and the whole roof has been replaced. So they do it in bits and pieces. So it's a repair, because you only do a little bits and pieces. But if you do the whole thing in one hit, then it's an improvement. Yeah. So if you're returning something back to its original condition, repair. Go beyond that, it's an improvement.
Very interesting. It's just a matter of the way that you do things and organise it. So
Okay. And again, I had a very interesting scenario many years ago where a client came in right on the 2nd of July to get their tax return done, and it was a repair, and I looked at it, it was about $15,000, and I started to ask the question, what is it? And it was a complete bathroom renovation, ripped out, and I just said, it's not a repair, it's an improvement. And they weren't very happy with what I told them. And 2 days later, they actually rang me and said, oh, have you started the returns? And I said, no, we haven't got around to them yet. And they said, good, we're coming in to pick them up. And they took it to someone down the road who I'm sure would have claimed it as a repair. Now, the only thing I can say to you about that is I have never, ever dobbed someone in to the tax office. I don't need to, because I know how smart the tax office computers are with their algorithms. So there is a little line in a tax return which is for repairs and maintenance. Every single one, agents fees, bank charges, they've got a little code. The ATO do a little algorithm, and I don't know what the number is, but I'm going to guess it's, say, $3,000, right, across all of Australia, and they go, right, tell us all the taxpayers who've got repairs and maintenance of more than $3,000, and the system will automatically spit a please explain letter out. And we've had a few letters where they've said, you've claimed more than that average. And there was one years ago that I had, which is a really interesting case. It was a $32,000 repair. And I looked at it and I thought, this is definitely a repair. And what happened was there was a tree that had grown at the base very, very close to a house. And what happened was they had to spend money to lift up the house, get rid of the tree, and then redo all of the foundations. And I looked at it and I thought, is that an improvement or is it a repair? And I thought, it's not an improvement. You haven't improved the property. All you've done is return it back to its original condition when there was a little sapling. So sure enough, the tax office looked, this is definitely an improvement. When I submitted everything, they went, you know what, it's a repair. So if you have a proportionately large claim like that, be prepared to get a little tap on the shoulder and have a please explain.
Yep. So questions to be answered.
That explains the difference between repairs.
Yeah, sure. So probably our last and final question. So what are the advantages or disadvantages and things to consider when having a space in your own home for an office or a small business?
Yep.
Is there some considerations, I guess, when I sell my home? So that's what Bree wants to know.
Terrific question.
Great question.
Yeah. Now, this gets into a little bit of an area of complication around capital gains tax and small business concessions. So I'll give you a simple example first. We'll just do a 2/3, 1/3. So say if you buy a house and you live in 2/3 of it and you decide to Airbnb 1/3 of that property, okay? And that's what it is from the day you bought it to the day that you sell it. What happens when you go to sell that property is that 2/3 of the gain that you make is tax-free, but 1/3 of the gain that you make is taxable, All right, it's just like a normal rental property. There's some really interesting rules around small businesses, and let's change the example where you live in 2/3 of it, but you run a hairdressing salon out of the 1/3 back, which a lot of people do. Now, what's interesting is that 1/3 gain is assessable, right? However, the small business concessions allow you to reduce that capital gain down to zero, and it's probably a little bit difficult to explain now, but you know, when you sell a property, if you've held the property for 1 year and 1 day, you get a 50% discount on the capital gain. You get that 50% discount on that little 1/3. You get a further 50% discount if it's a small business. So you could actually reduce the capital gain by 75%. Then you've got the 25% that's left over that you have to deal with, and that's the bit you've got to get some advice around, because you can get that actually out tax free.
Great question, great answer.
But it's a really interesting scenario, especially with people who work from home, and it's actually thrown a bit of a spanner in the works with people who work from home now around COVID, as to whether it's jeopardising the tax-free status of the family home. You really want to try and get that principal place of residence 100% tax-free. So you don't want to stain it with any sort of non what do you call it? Private, living. But when you do, you've got to deal with it.
Yeah. Okay. Look, we might wrap it up there, because I think we've gone over time a little bit and taken up enough of your time. So I'd like to thank everyone for joining us tonight. Again, the live streams change every 3 weeks. There's different speakers, different content, different things. Before we do go, Tony, how long have you been an accountant for? How long have you?
39 years. So I had
39.
I had my work anniversary on International Women's Day. 8th of March is my 8th of March is my work anniversary. So yeah, just clicked over. So I did it straight out of school. Joined a very small firm, and just love it. Really enjoyed it. So I love the interaction around clients, helping them out, especially in the Newcastle and Maitland market, because you're dealing with the person who pays you. So you're not dealing with like BHP, where you send them a bill for the audit, and someone else is paying. You're dealing with mum and dad, so you've got to look after them. You've got to give them value, and if they don't think that they're getting value, they'll sense it very quickly and move on. So yeah, I've enjoyed it.
Okay, great. And for our viewers out there, is there any particular area in accounting that you specialise in, or what can you help people out with?
Look, we my ideal client, I was asked this the other day about my ideal client. My ideal client is someone who's rational. We look after very large, some well-known names, right down to the little old lady with a passbook and a pension. We'll look after everyone as long as they're rational. They don't ring like 5 times in 20 minutes, when it's urgent. We just need people that fit in with the culture that I've built in our firm, I think we give people a really good experience, and that's why they keep coming back. I tell my staff that people don't keep coming back in our firm just to get tax returns done, and they kind of look at me as if I've got 3 heads. I said they keep coming back because we give them a good experience, and that to me replicates around everywhere, whether you're a cafe or a pub or anything that you do. If you give people, whatever business you're in, give people a good experience, they're going to keep coming back. And
I think that's key. A big thing I believe in is if you don't look after the customer, someone else will.
They'll sense it. Indifference. Yeah, if you're indifferent to a client, I'll tell you now that they'll smell it a mile away, and they'll move on. So
and where are you guys based?
I've got 2 offices, one at Waratah and one here at Maitland. So and again, all things we've spoken about property today. We've got a lot of clients who spend a lot of time around helping people around properties, subdivisions, GST, which we didn't get to because that gets a bit complicated. But yeah, I've got a soft spot for property, so I've invested over the years with it, and I just love being around property.
Yeah, great. All right. Well, look, thanks for your time today.
Yeah, pleasure. Wonderful. Thanks, Scott.
Hopefully you got something out of today. From all the answers, I guess, that Tony provided is a wealth of knowledge. If you're looking to change accountants and need someone, Tony's your guy. If you don't have an accountant and you need someone, Tony's your guy.
Just don't ring me 5 times in 20 minutes.
So feel free to try and reach out with him. If you do have trouble reaching out to Tony or AV Chartered Accountants, get in touch with ourselves. I'll be more than happy to put you in touch with Tony. But look, we look forward to seeing you at our next live stream, which is, I believe, on the 8th of April. And we look forward to seeing you then. Thanks for now.
Wonderful. Thanks. Very well done.